In the short run, the stock market is a voting machine. In the long run, it's a weighing machine. That's from Ben Graham's Security Analysis, published in 1934. Today, 22 million Americans are unemployed. Morgan Stanley now predicts that US GDP may collapse by as much as 50% in Q2 of this year. Entire swathes of the US economy, airlines, cruise lines, hotel chains, energy companies are on the verge of bankruptcy. And yet, the US stock market has rallied over 50% from its bottom. How does this possibly make sense? How can the performance of the stock market divert so much from the real economy? In the short term, the stock market is a voting machine. In the long run, it's a weighing machine. If you choose to invest in financial markets, you must make sure that you don't make the rookie mistake of confusing the two. Now, here are 3 things to keep in mind. First, economic analysis is irrelevant for the short-term financial investor. Now, you can analyze the economy until the cows come home. You can review the most recent epidemiological models on COVID-19. You can generate detailed reports. You can cite the world's top investment banks, just like I did. But none of this matters for the short-term financial investor or trader. In that sense, these reports are worse than just wrong. Not only are they not providing the right answers, they're not even asking the right question. Second, don't feel bad. A lot of smart people don't get it. I'm a member of an informal investment group consisting mostly of Harvard MBAs. Every Saturday, we get on a call to discuss our market outlook. The tone of these calls is remarkably consistent. As these folks work in the real economy, their outlook is almost uniformly negative. How can the stock market keep going up, they ask. The economy is getting crushed. The stock market is clearly wrong. Investors just don't get it. Perhaps. Time will tell. But here's what the Harvard MBAs don't get. Over the short term, the stock market is driven by sentiment, not by fundamentals. The rule of thumb is that the stock market discounts the future by about 6 to 9 months. Stock market investors today are not betting on the market conditions today. They are betting on what they expect them to be in about Q4 of 2020. Number 3, the world's best investors do get it. Buffett described Ben Graham's 1949 classic, The Intelligent Investor, as, quote, by far the best book on investing ever written. Why? Buffett credited Graham's discussion of the manic-depressive Mr. Market as the single most important thing he had ever read. Now, Mr. Market is a manic-depressive who offers to sell you his stock in companies every single day. When Mr. Market is in a good mood, he will ask for a high price for his stock. When Mr. Market is in a bad mood, he will sell his stock to you for a pittance. Understanding Mr. Market's irrational mood swings has given Buffett a massive advantage in timing his investments. Now, as a student of the father of value investing, Ben Graham, Buffett does understand that long-term value converges to intrinsic value. That's why Buffett says you should invest only in stocks where you would be comfortable with the stock market being shut down for over 5 years and not let it bother you. But Buffett also understands how to take advantage of Mr. Market's mood swings to maximize his returns. Buffett understands that in the short run, the stock market is a voting machine, and in the long run, it is a weighing machine. And if you want to be a profitable investor, you must understand this too.